Cytonn Investment, which has over Kenya shillings 82 billion of investments and projects, today released its first half 2018 banking sector report, which aims at helping investors to determine which banks are the most attractive and stable for investment for a franchise value and future growth opportunity perspective. The report ranks KCB Group as the most attractive bank in Kenya, a position it has retained since 2016 financial year. Supported by a strong franchise value and intrinsic value score, it was ranked first on the back of a high return on average equity of 21.9% compared to an industry average of 19.5%, as well as high efficiency with a cost of income ratio of 52.0% compared to an industry average of 55.7%. Equity Group ranked second, recording the highest return on equity at 23.9%, the second best net interest margin at 8.8%, above the industry average of 8.1%, and the third best efficient bank with a cost-to-income ratio of 52.8%, above the industry average of 55.7%. Faith Wangari, an investment analyst at Cytonn Investment, pointed out that the lowering of the central bank rate from 9.5% to 9% and the increased 8% levy on petroleum products have a trickle-down effect.
On interest rates, we had predicted a stable outlook on interest rates, and we had expected that CBR will be maintained at 9.5%. However, year-to-date experience is that the Monetary Policy Committee has lowered the CBR to 9%, citing that there was need to improve economic growth. And going forward, we expect that the interest rate environment will remain relatively stable. We don't expect that MPC will lower the interest rate going forward, but we remain neutral on the interest rate environment. On inflation, we had targeted that we'd have the average above the government annual target of 2.5 and 7.5%. So far, the inflation averaged at 4.2% in the first 8 months of 2018, and the year-on-year inflation rate for the month of August declined 4% from 4.4% in July. Going forward, we expect that the inflation for H2 2018 is expected to increase due to the increase in VAT that will be charged on fuel and other commodities in the market. We, however, expect that the inflation will still remain between the target of 2.5% and 7.5%.
Morethi Kagiri, an investment analyst at Cytonn Investment, added his voice on the proposed draft financial market conduct and how it will translate to the customers in the long run.
So the draft financial markets conduct bill will likely come in place and remove the hidden charges that customers have been accusing banks of levying. So the financial markets conduct bill is, as I said, customer-centric. So it's likely to improve credit consumers in terms of decision making to ensure that they do make more informed decisions.
Despite a strong showing in the first half of the year, in lieu of a hostile operating environment, the banking sector is far from being in the clear. It is, however, the hope of many that the continued adaptation of technology will cushion the very important economic sector. Reporting for Bramplus TV, I am Korari John Wambugu,
Chairman of the board, current